Hi, friends. Thanks for watching. My name's Samaya, the founder of the Legacy Circle, and I help my clients both in the growth phase of their retirement planning, but also the income phase of the retirement planning. And in today's video, we're going to be breaking down all things annuities. So if maybe you've heard of annuities or you've been looking into them for a little bit to figure out if it makes sense for you and your situation, this video will make it crystal clear, breaking down exactly what they are and if it's something that you should look further into. So let's jump right into it. We're going to be covering what is an annuity, the different types of annuities, and of course, identifying if this makes sense for you and your situation. So, first thing first, I'm going to be moving my little self around here. What is an annuity? So, an annuity is an agreement between an insurance company and you, where you either make a lump sum payment or a series of payments, and in exchange, the insurance company will commit to providing you with regular payments either immediately or starting at a later date of your choosing. So, the who and the what. So, the who is the contract of an annuity is between you and the insurance company, right? Contract owner is you. You're the owner of the contract, and the insurance company is just in part of that contract, right? Now, the insurance company will accept your lump sum amount, your monthly payments, whatever it is, and issue an annuity contract to you that, in the terms of the contract, will credit you interest. And of course, that varies based off the terms of the contract. And the annuity is in force until you, the contract owner, surrenders the annuity or passes away. It will end if you withdraw all your funds from the annuity or you convert it into a stream of payments from the annuity. Okay, so why do people even purchase an annuity? Okay, now annuities have higher interest rates than other options like your CDs or savings, high yield savings. They're going to be able to, depending on the terms of the contract, potentially offer you a higher yield in your interest. Now, they also have tax deferred growth, meaning that as the interest is building, you're not paying taxes on that every single year. You get to allow that pot to continue building without a chunk being taken out of taxes, which obviously affects the growth. So you pay no taxes until you actually start withdrawing the money from the annuity. And it has the ability to create a guaranteed income stream for life in some cases, depending on the contract. So the different types of annuities. Now, there is the deferred annuity where you accumulate some money into the annuity contract, you defer paying taxes on that money, and years in the future, you can start taking a income stream. You can start taking payments from that annuity. Or there's immediate income annuities that as soon as you enter that contract with the insurance company, they agree to start making payments to you right away. Now, there's phases of a deferred annuity, which is obviously the accumulation phase. So, as your money is sitting in the account with the insurance company, it's going to be building interest, growing cash value. And of course, the payout phase is whenever you start receiving income from that annuity. Okay, so the accumulation phase of an annuity, it varies depending on the type of annuity. So when I say annuity, maybe you guys hear annuity and some of you guys are immediately thinking, oh, bad, something from the 80s that people lost a bunch of money in. A lot of the time when people hear annuity and have a negative connotation to it, it's because they're thinking about this specific type of annuity, a variable annuity. Okay, so this type of annuity is riskier because it invests into sub accounts like mutual funds, and it can gain money, but it also can lose money. There's no protection like there is with your traditional fixed annuities or fixed index annuities. Okay. Now, a traditional fixed annuity, it pays you a set interest rate. So it's safe, it's predictable, right? These rates for a fixed annuity are typically a little bit lower. Obviously, it depends on the market, but anywhere from like 3 to 4%, maybe even 1 or 2% in a bad annuity contract. But you at least know for sure, no matter what the market's looking like, I'm getting my same fixed rate per terms of the contract. Now, with the fixed index annuity, this growth is tied with the market, but there's no risk of losing money with the market. So even if the market goes down, your principal is still protected with the fixed index annuity. Same thing for a fixed annuity, except it has that fixed rate of growth. And with the fixed index annuity, it has potential for higher returns because it grows with the market, but it won't lose with the market. That's important. All right, so let's talk about some of the common features between your traditional fixed annuities and your index annuities. Okay, so typically with these contracts, there's not a whole lot of fees or charges for the product, except for a potential surrender charge if you withdraw too early. So a lot of times with annuities, they'll build into that contract saying that you still have access up to 10% of the funds every single year. It could be more, it could be less, just depends on the company and the contract. But if you go over whatever percentage they give you access to, then that's when they hit you with a surrender charge. But outside of that, of course, it varies between what your contract consists of. But at a basic level, there typically isn't a whole lot of fees or charges. Now, you do typically also get a minimum guaranteed withdrawal value. So basically saying if the market or the economy just absolutely crashes, you still have guaranteed what your value would be as far as either continuous payments or a walkaway value. Even worst case scenario, you're always guaranteed something within the terms of the contract. Okay. Now, annuities can be issued anywhere between age 0 and 90. And then you have your minimum guaranteed interest rate. So, kind of the same concept as far as if the market does its worst, you're still at least guaranteed X percent. And it's usually like a 0% floor, meaning your principal is protected. And these vehicles give you the ability to convert your savings into a lifetime income. All right, so some more common features between the fixed and index annuity is that you get your tax deferred growth, meaning that the account value is able to compound and grow a little bit more because not a chunk is taken out every single year due to taxes. And then you do have partial withdrawals most of the time within these contracts, meaning you're not locking all your money away for years and years. They do give you access to those funds, and it's usually around 10% per year without any type of charges. Now, like I said earlier, you go over that 10%, that's when they hit you with the charges, but you do have partial access to your funds. Now, these contracts are pretty competitive between insurance companies because obviously they want your business, right? So as long as you're working with a solid advisor that's doing their due diligence, there's some pretty competitive rates that you can get in index annuities and even fixed contracts because the market is so competitive when it comes to annuities and insurance companies. Now, there is a declining surrender charge. So, like I said, you go over that 10% withdrawal, they hit you with those surrender charges. But every single year, the surrender charge gets less and less and less. So, for example, year one, your surrender charge might be 20%, but in year two, it might be 17%. Year three, so on and so forth, right? And we do get market value adjustment. So basically, depending on how the market's looking, how the economy is looking, usually insurance companies may fluctuate the amount of interest that you receive or the income that you receive. It's flexible. Now, when it comes to an immediate income annuity, okay, this is when the you give the insurance company a lump sum payment where you've been paying into it for a series amount of times, but usually it's going to be a lump sum, and then in exchange they guarantee a stream of income payments immediately, right? So the payments are going to be determined by your age and the interest rate at the time the contract is issued, and it's guaranteed for a certain period of time or for life of the owner, depending on the terms of the contract. And your payments typically will not fluctuate, regardless of the market changing. Your payments are locked in based off the terms of the contract. So, does this actually make sense for me? Does getting an annuity make sense for you and where you're at? So, let's talk about some of the characteristics of a client who might want to look further into getting an annuity contract. So, maybe you're saving in a CD, a money market account, bonds, or traditional retirement accounts like 401ks, IRAs, TSPs, 403bs, anything really where you've been stashing money aside and you have a lump sum of money that you're looking to move. Yes. Okay. Now, if you want to avoid taxes on that interest growth in the near term with that lump sum of money, yes. Also, if you're concerned about market risk and you want protection of your principal. So, a lot of time, people with their traditional retirement accounts, 401ks, IRAs, they will look into annuities because they still want the market potential growth, but they don't want that market risk anymore. Now they're looking at that thing to serve as income for the rest of their retirement years. They don't want it to be exposed to any type of market risk. So, if you're in the same boat, then yes, an annuity might make sense to look further into. Maybe you want better returns that you've been getting in your CD or another fixed rate account. And obviously, like I said earlier, these vehicles give you more opportunity for market growth. Once again, if you're seeking security over risk, you prefer clear, predictable growth, and want full transparency on access and withdrawal options, then yes, an annuity might make sense for you. And again, also, if you're looking for a guaranteed income stream, if you just want to say, hey, here's my lump sum of money I've been saving for retirement. I want the insurance company to guarantee every single month I get a set amount of income, then yes, this might be a good solution for you. Now, finally, if you need full access to your funds within the first year, or you just don't have funds right now to reposition into an annuity contract, this most likely won't make sense for you because remember, annuities give you access to a portion of your money, but not all your money within the first year. So if you need full access to that money within the first year, annuity contract probably wouldn't make sense for you. And once again, if you don't have any funds from a savings, a retirement account, really anywhere to reposition into an annuity, it also will not make sense for you. All right, so uses of an annuity, right? We've talked a lot about it paying you an income, but obviously there's different uses of an annuity. Maybe you're not just looking for retirement income, maybe you just have money that you want to see accumulate a little bit better without the risk of market exposure. Maybe this is just to supplement some income. It's not your primary source of income, but it would help to have a little supplemental coming in. Maybe you want some long term care expenses. Sometimes annuities have additional riders that will include long term care features if that's a part of an annuity contract you want to include. Maybe you just want to make sure that it's easy for your estate to receive funds whenever you go, because annuities function similar to life insurance in that extent, where it's not something that has to go through probate and go through the courts. If you have a beneficiary already designated on your annuity, the estate planning, the estate transfer is a lot simpler than leaving that money tied up in like a 401k or a brokerage account and then having that process to go and get that money to the family. Now, also, these vehicles are similar to a CD, but of course, you get a little bit potential for higher growth, and that growth is all tax deferred. And if you're looking to kind of reduce your taxable income for a few years, then this is when a vehicle like an annuity would make sense because anything that's in the annuity is not reported as an income until you start taking income from it. So if you just want to reduce your taxable income for the year, put your money into an annuity. That way you don't have to worry about paying the taxes on it until a little bit later. And then, of course, if you are looking more for an annuity for the insurance features, like I said, for the death benefit that could pay out to your family, if you're looking for the long term care benefits, maybe the lifetime income options, you can customize your annuity based off of you and your goals. It doesn't just have to be something that pays out income right away. It could be something that also is used as a legacy death benefit to pay out to the family, so on and so forth, right? There's multiple uses. Okay, so let's go through some example clients, right? This guy, he's 64-year-old widower. He has no experience in the market, never really got into stocks or different things like that. And he's looking for a vehicle to place funds that he recently received from his deceased wife's life insurance. So he got a lump sum payout from the life insurance claim, and he just wants something that is going to grow his money still without any type of market risk because he doesn't have a whole lot of market experience. And he wants these funds for his kids. He doesn't really look for any type of income from it. Of course, he can if he wants to take income, but ultimately, this is for legacy purposes. He doesn't want a long-term commitment, and he's used to CDs. He's already put some of his money into CDs, so he's very familiar with the concept. So the solution for him was a deferred annuity, not an income annuity, because he doesn't really need the income right now. It's going to be a deferred annuity so it can continue to grow that cash value for him to the point where in the future, if he does decide to take an income from it, he can, or it could just go to the children that he has and all that cash value growth. Okay, next client. This lady is recently retired. She has a moderate investment portfolio. It's dominantly an amount of equity investments, so stock investments, and she's not really in need of an immediate income because she has her other investment portfolio. She just wants to diversify a little bit. She wants some of her money to be protected because right now she's heavily in the stock market. So our solution for her was an index annuity where she still can get market-like gains, but now no losses. Her principal is protected even in the worst of market crashes. And finally, we have this 70-year-old husband and his 60-year-old wife who are both retired. They currently own life insurance policies that have accumulated some assets between the life insurance and their other assets, and they just need more income, right? They are retired now and they need to start using their retirement portfolio to pay them an income. So our solution, an income annuity that they give the insurance company a lump sum of money from their different assets and vehicles that they have to enter a contract where the insurance company is going to pay them a set income for the rest of their life immediately. That's pretty much it. I hope this brought clarity to some of your questions in regards to annuities and figuring out if it's something that you should look further into. So, if you need help putting together a retirement strategy based off of your situation, use the link in the description box to book a time with me, and we'll hop on the call, break down exactly where you are currently and what vehicles we need to align and put into your strategy to help you get to where you want to go. So, be sure to like, comment, and subscribe, and stay tuned for the next video. Take care.